I'm Bob Landaas, president of Landaas Company. So this year marks my 40th year of managing money in Milwaukee. I've learned a few things along the way, some of which I'd like to share with you this morning. Now, my job is to explain economics and the markets, both domestically and internationally, and do the best I can to discuss possible and probable outcomes. I say this at every seminar. A number of you have given us your money to invest because you either don't have the time, you don't have the interest, and others are very engaged in the process. So the struggle that I have is I need to spend some time at the grade school level for some of you, but I'm compelled to spend some time at the graduate school level and even at the PhD level for others. So I'll do the best I can to keep things simple here. The United States was at the center of the financial crisis in 2008. This time around, it started on the other side of the world in China. So it's important to spend a little bit of time talking about China, what's going right, what's going wrong, and to talk about how we think it's going to play out. So many of you know that China spent the better part of the last 30 years building infrastructure and manufacturing facilities, and they got a little carried away with it. So the economic return, when you build the first freeway, you get a pretty good bang for your buck. When you build the 100th freeway, not so much, and by the time you're building the 1,000th highway, the return on that investment dwindles down towards zero. We've seen the proverbial bridges to nowhere. They have stadiums without sport teams, airports without commercial service, and manufacturing way beyond their ability to produce goods and services. So in the beginning of August, they started devaluing their currency. And folks, when you devalue your currency, it's what we all used to call a Hail Mary pass. The bottom of the fourth, you're down 10-0, and you tell everybody on your team to run to the end zone, and you throw it and hope somebody catches it. So you don't devalue because you want to, you do it because you have to. So that, along with an 8% drop in exports out of China in July, really took the markets by surprise. It's proving difficult for the Chinese to reorient their economy. Economists have known for years that they need to develop consumer spending, buy and sell to each other, instead of just trying to flood Costco's and Sam's Clubs and Walmart's with their cheap goods. So reorient their economy is proving pretty difficult. Now, the primary impact on the slowdown in China is in the emerging world. So think either you're selling copper from Chile to China, iron ore from Brazil to China, Russia would sell oil to China, and now simply China is not buying as much as they used to. So it's the emerging world that is really feeling the brunt of the slowdown in China. Now the problem that's been created, of course, is we have, it sounds complicated, it's not, diverging monetary policies. Whenever the world has struggled with diverging policies, the markets have become volatile. So in English, what this means is we're just on the cusp of raising interest rates in the United States. The European Central Bank, the Bank of Japan, and the Bank of China are in the process of lowering rates. So as we raise rates in the United States, it makes the dollar more desirable, and people are pouring into the US currency. So the dollar is stronger at a time when the other currencies are weakening, and that's the crux of the dilemma. US dollar strength began in January of 2014 when the Federal Reserve here in the United States made it real clear that they would eventually raise interest rates. Now think about that. They've been talking about that for over a year and a half now. And at some point, I suspect they will raise rates, but it's making the dollar more attractive. So here's the issue. Since the financial crisis, many emerging markets have borrowed in dollar terms. Didn't it used to be like that prior to the crisis? So if you're in Malaysia and you borrowed $1 million in dollars, and your currency fell 20% against the dollar, it effectively increases your loan obligation by 20%, right? Because the currency that you live in fell 20% against the dollar. So that's problem number one. Problem number two is it's become more difficult for you to pay back because your economy is weakening because you don't export as much as you used to China. So if you're the head of Malaysia, you're between a rock and a hard spot. You can't raise interest rates to defend your currency or you're going to put your economy into a depression. You can't lower interest rates to stimulate economic growth as you'd normally like to do, or you're going to collapse your currency, right? So in many places in the emerging world, they're stuck. Their monetary policy, they can't go one way or the other, and they're just going to let the storm blow through. Now, the impact on the United States, in the opinion of many, is that the U.S. is unlikely to be hampered by the recent turmoil in China. More than any other developed nation in the world, the U.S. depends primarily on demand within our borders. I mean, consider that consumer spending, you've all heard this data point forever, 70% of our economy is consumer spending. It's half that in China. Only 35% of their economy is consumer spending, and it's one of the lowest rates in the world. So I think we can all agree that the rate of growth in China is slower than what has widely been thought. If you look at their long-term trend, 9.8%, look at how they were growing 10 years ago, quite a bit higher. Last winter at a brokers meeting at the firm, we were talking about a research report that came out of Hong Kong. It was written by this brilliant woman who had been smart enough to track electricity usage in China. So if you make pens, and you claim to me that you're making 10% more pens, I better be able to figure out that you're using 10% more power to produce your pens. And lo and behold, she figured out, along with her research staff, that the rate of growth was more like 4, not the 7.5 that they were advertising. Privately, the American funds did a similar study the next month, but they went around it a different way, and they were looking at transportation. So if you tell me that you're producing 10% more pens, I better be able to figure out that you're using 10% more trucks, 10% more rail cars, 10% more boats. Somehow you have to transport the goods that you've produced. And not so surprisingly, the research showed a similar number, that the rate of growth in China was more like 4%, not the 7.5% that was widely advertised. Now, short term, China has the one thing that we don't have, which of course is control of their currency. So the Chinese can continue to devalue their currency to make their goods more competitive overseas. There's a limit to that, of course, because there's now a race to the bottom. Everybody's devaluing their currencies to make their exports look more attractive. And to be fair to the Chinese, it's very hard to measure consumer and the service sector. Right? Manufacturing is easy to tabulate, but to try to figure out the rate of growth in the service sector in China and the consumer sector in China is much more difficult. Quite frankly, no one really knows for sure, and that might include even the leadership in China not quite knowing what their rate of growth is. But please be clear that China remains an economic powerhouse, but their pace is turning out to be a little bit slower than what people had thought. So this chart talks about the collapse in commodities prices. Been pretty dramatic, folks. I mean, whether you're talking about oil, gas, the agricultural commodities, my goodness, corn used to be $9 a bushel back in '07. Last time I checked, it's about $3.74 a bushel. The industrial metals, the precious metals. You look at the chart right in the middle of the page, that's about where they peaked out in the springtime of last year, and they've declined dramatically. So 2 points I'd like to make. In 3 out of 4 cases when commodities prices collapsed in mid-recovery, the bottom preceded accelerations in economic growth. Okay, as a trained economist, I think this is common sense, but the point simply is, if you make pens, you're in the middle of the economic cycle, your cost of raw materials to make the pen just went down, you're going to make more money. Okay? The greatest recession risk typically occurs after a surge in commodities prices. Right? Again, what I think is common sense. If the cost of the raw materials to manufacture the pen goes up, I'm going to run into some restraints. So commodities prices have clearly gone down, and a lot of this is being driven by a slowdown in demand in China. Raw materials around the world, whether it's oil, iron ore, copper, or the agricultural commodities. So we've seen the dollar strengthen dramatically against all of the world's major currencies. This chart goes back to 2011, and you can see that against the euro and the yen, the dollar is quite a bit higher. Some of you may know that many of the world's commodities are sold in dollar terms around the world, and as the dollar strengthens, it forces the price of commodities down. So we're going to spend a little bit of time this morning talking about the headwinds and the tailwinds of a stronger dollar. The easy one to talk about, of course, is that a stronger dollar creates headwinds for large U.S. multinationals. The key to understanding this is the Fed's not going to be increasing interest rates forever. Okay? And as they reach the end of that, it'll probably be late next year, the dollar is widely anticipated to level off and then start declining. You know, for the last 2 years, my favorite data point came from the World Bank, where they estimated that there are about 800 million people in the middle class worldwide. The World Bank estimates that that number is going to triple by 2030. Next 15 years, middle class in the world is going to triple. None of the growth is going to come from the developed world. So if you look at the middle of this chart, it tells you where the world's going. So the blue line is where we were 6 years ago. Green line in the middle is the forecast just for 5 years from now. Brian and I were looking at this chart the other day, and he pointed out, look at Asia, the growth just in 5 years for the middle class. Big increase from where they were 6 years ago, way more than double just in 5 years now. Let alone the increase that they're forecasting 15 years down the road. Look at the size of that middle class. Folks, that's what's going to be powering economic growth for the longest time. World Bank still thinks that Asia will remain the fastest growing region in the world for years and years to come. I was reading a research report from the World Bank just a little bit ago. It was authored by a guy named David Dollar. I love that. Of course, the guy works for the World Bank with a name like that. I used to buy my clothes from this store, Roger Stevens, downtown. The guy that sold me the clothes, his name was David Shirts. That's another one. And then when I was a kid, outside New York City, my orthodontist is an Italian guy named Dr. Del Tutto. Well, of course, that guy wound up as an orthodontist. But back to David Dollar and the World Bank study. There have been all sorts of cases of authoritarian regimes, autocracies, directing capital to build infrastructure, and they can grow pretty quick. But there's never been a case in the history of the world of an autocracy building a middle class. It's never happened. Now, if you think about this, to build a middle class, you have to encourage entrepreneurship. To encourage entrepreneurship, you have to allow free speech and free assembly. And the simple point, of course, is China doesn't allow either one of those. So the difficulty for China longer term is they have to build a middle class. They don't have one, right? They have a fair number of rich people and then a whole lot of poor people. And the reason why consumer spending is barely a third of their economy is they do not have a middle class. So the experts from the World Bank will tell you that if you look at where China is now, it's where Japan was per capita income wise in the early 70s. It's where Taiwan was in the early 80s, and it's where South Korea was in the early 1990s. And as I'm sure you all know, Japan, Taiwan, and South Korea are effectively democracies. So they were able to encourage building a middle class, which propelled them to be among some of the strongest countries in the world. I'm a big fan of democracy, I'm a big fan of capitalism, and I think when you combine the two, you got something to talk about. So that'll be the struggle in China, big picture, longer term, moving forward. As I said, thanks to David Dollar, there's never been a case of an authoritative regime that's built a middle class. So this chart is kind of interesting because it talks about the impact of urbanization, right? You look at the top where you can see per capita income in the United States. Most recent data points are from 2 years ago. Per capita income, so this is every man, woman, and child in the country, on average $53,000. But look at the rate of increase in urbanization in the United States just since 1961, right? As more and more of us move to urban centers in the United States, per capita income climbed dramatically. Look at the same in Japan. It's unbelievable to me, 94% everybody in Japan lives in a city. South Korea, the same story. Brazil, you're starting to see a move towards urbanization there. And the increases in per capita income do this. So go to the far left of this slide and take a look at India, right? Fewer than a third of the folks in India live in cities. Look at China, right? Roughly half of the people in China now, 1,300,000,000, live in cities. So as more and more folks move to the cities, because that's where the jobs are, you'll see a fairly dramatic increase in per capita income. And they, frankly, just have a really long ways to go. So the point of all this is that, yeah, China's slowing a little bit. That's adversely impacted the emerging markets. But big picture, longer term, you can see on this chart that the advanced economies, the developed world, are contributing less and less to global growth. It's not so much that we're going backwards as it is the rest of the world is playing catch up. So you can see the red line down at the bottom there. That's the emerging world. As recently as the year 2000, the emerging world was only contributing a fifth of global growth, just 20%. And now, as you can see, it's over 43% of global growth. So the U.S. continues to grow while China slows. Because consumer spending, as I said, drives our economy. It provides a buffer against global woes. So you go down the list, pretty nice list. Strong job growth, jobless claims, first-time claims for unemployment have recently fallen to a 15-year low. Wages are gradually rising. I'll get into that in a minute, more detail. Not as much as we'd like, but nevertheless, with strong job growth, we've been averaging over 200,000 new jobs a month, and wages are going up just a little less than 2% a year. In most metropolitan markets in the United States, housing is now back to pre-recession levels. Consumer confidence is coming fairly close to the levels that we saw prior to the recession. So that's good news, of course, driving consumer spending. You need a job, you need wages, and you need your home equity to improve, and then that ultimately translates to higher consumer spending. We've seen falling energy prices for quite some time now. Oil was a little over $100 a barrel. Last time I checked, it's about $42 a barrel. And the economists were kind of scratching their heads over this one for a while. Last summer, everyone was told that the average American was going to save about $300-400 because of lower fuel costs. And then by last fall, that translated to almost $1,000. And not 5 cents of that wound up in retail spending. The thought was that a lot of the money went down to pay down credit card debt, and some people saved it. But the economists are fairly confident that lower oil prices will ultimately translate to higher spending and higher savings, both of which, of course, are good for the economy. So Isabelle's going to get into this one in a bit. You know, there are a handful of things that companies can do with cash, and as she'll point out, the most profitable thing they can do is grow their companies organically, and we're finally, after all this time, seeing signs that business spending is improving, and as I show here, it's the strongest gain in a year. So if you look at the GDP forecasts, they're fairly encouraging. The pros think that GDP, the broadest measure of goods and services produced in America, is going to climb about 3 to 3.5% for the second half of this year and all of next year. Folks, keep in mind, long-term average for GDP is 3.4. So we're getting pretty close to back to average here in the United States. So I don't get many chances to quote Spiro Agnew, but here it comes. Negative nabobs of negativism, right? That's what Spiro launched. He was tired of all the doomsayers. Well, frankly, so am I. I'm sick of people telling me that this country is on the wrong track. Our economy has never been stronger. You take a look at this chart, look on the far right-hand side. The economy in the United States has never been larger, and it's never been stronger than it is today. So, of course, the size of the economy drives corporate profits. You take a look at the next chart. This one's on payroll. Okay, this is pretty interesting. U.S. employment has never been higher in the United States. In spite of all the bad news you read, there are more people working full-time in the United States today than ever before. Now, we had a pretty good hole to climb out of. Look at the middle of this chart. Almost 9 million people lost their jobs during the financial crisis. So guess what? We've recovered all of those jobs, plus a wide margin. So the economy in the United States has never been larger, and we have a record number of people working full-time in the country. So this next one is what gives me hope for consumer spending in the future. The short version of this story is people are paying down their debt. Now, granted, during the financial crisis, part of that happened because of bankruptcies and foreclosures, but take a look at the 30-year average here. What we're talking about is household debt service as a percentage of your monthly income. It's fallen now quite a bit below the 30-year average. So that's a good thing. Consumers are gradually now increasing their spending, and they've got a fairly large capacity to increase their ability to assume debt. For years, people have been telling me that inflation was going to skyrocket because of this, that, or something else. There's something else I'm sick of hearing. It's time for those folks to give it a rest. The big question that economists face right now is why aren't wages and inflation going up in the United States? So the Federal Reserve Bank of Kansas City holds an annual meeting in Jackson Hole, Wyoming. Just happened a couple of weeks ago. This was the question. This was the topic at the Fed conference in Wyoming. Why isn't inflation going up? Right, so most of you know that the Fed has had a target of 2% inflation for a number of years now, and despite exceptionally low interest rates, they can't get it there. So year over year, the last measure, Consumer Price Index, covers everything. Inflation was only up 1.3%. Okay, now I'll spend a minute talking about the big picture. In the 1930s, when they created the Federal Reserve Board in the United States, its primary mandate was price stability. It's why we created the Fed in this country. So their primary responsibility is to make sure that inflation doesn't take off. Rightfully so, as a country, we're phobic about inflation. The problem is, once that little genie gets out of the bottle, it's really tough to get it back in. So we created the Fed in the United States to maintain price stability. For years, in business schools, they've been teaching the concept of full employment, right? Full employment is 5% unemployment. And we found out during the mid-90s, Alan Greenspan called it the economic miracle, but we actually had unemployment in the low 3% range for a couple of years, and it didn't trigger inflation. Of course, looking back, we now know that that was at the start of globalization when a lot of U.S. manufacturers We're building maquiladora operations down in Mexico and then ultimately going to China and to the rest of Southeast Asia to reduce their unit labor costs, and that kept a lid on inflation around the world. But it absolutely has turned the Fed on its heels. That for years we thought that under 5% unemployment, it's time to raise interest rates, inflation is just around the corner. So if we continue with the 200,000 new jobs on average a month, it's forecast that unemployment is going to drop to 4.3% at the end of next year. 4.3, okay, pretty low number. So inevitably the Fed has to raise interest rates, but it's got a lot of people scratching their heads. The worry that I had wasn't whether inflation was going to take off or interest rates were going to take off. I kept worrying, as many of you would know, that what if interest rates went down and stayed down? And damn if that's not what's happened. That interest rates fell and stayed down. It presents a whole different set of problems to worry about. But the popular press has been meowing for years that inflation's got to skyrocket. And it's not. It's barely measurable. So to totally beat this point to death, I want to give everybody a little refresher course on the three things that create inflation. There's only three, okay? Got to go back to my little pen company, okay? There's three ways for inflation to go up. Number one is through wages. Typically halfway through a business cycle, you're no longer hiring from the ranks of the unemployed. You got to take workers from other companies and you got to pay for that, right? Wage growth is half of the long-term average. And there's still plenty of people out of work, so wages haven't gone up. So I don't need to pay more for my pen workers above and beyond the standard 2%. Number two, I need raw materials to make my pen. And as I showed you just a bit ago, every major commodities group has plunged in price since the spring of last year. Number three, I need a place to make my pens, okay? And we call that capacity. Over 40% of the plant and equipment in China today is sitting idle. You want to manufacture something? Jump on an airplane, go to China, rent a plant, it's pretty cheap. 23% of the plant and equipment in the United States is sitting idle, although a lot of that is obsolete. So aren't any big increase in wages. Commodities prices are going down, and there's plenty of place to make your product. So as a result, it's not inflation that's going to be the problem. So if you look at this chart, this one's kind of interesting because it shows how dramatic the inflation was in the 1970s, leading up to the spring of 1980 when Ronald Reagan, Paul Volcker decided enough is enough, we're going to break the back of inflation. And you look back in the history book, they're going to credit those two as helping to save the world. So interest rates have been going down ever since August of 1980. And along with that, the inflation rate. You take a look at the 50-year average of inflation, boy, it's a big number, 4.2%. But please note that ever since 1992, inflation hasn't spent hardly any time above the long-term average. And then, of course, you look at the far right of this slide, you can see that inflation is about heading towards zero. So here's something that the Fed is scratching their heads about. Labor force participation rates. Number of Americans age 18 to 65 that work full-time continues to decline. Take a look at the drop since the financial crisis, was just a little bit below 67% of all adult Americans working full-time. The number has dropped dramatically, and along with that, so has the unemployment rate. If you look at wage growth, most new jobs created in the United States since 2008 have been in food service and healthcare, none of which pay, which is the primary reason why wages collectively as a country haven't gone up much. You look at the 50-year average for wage growth, 4.3%, we're half that right now in the United States. So back to the graduate school level just for a second, we talk about the velocity of money. This one's easy to explain. If the Fed is trying to stimulate, and the banks are able to borrow at less than 0.25%, there's one key thing that has to happen, which is the banks can't sit on the money. They have to circulate it, right? And they're not. And as a result, the money supply hasn't been multiplying. So some of the old timers will tell you, hey, wait a minute, Bob, the Fed has quadrupled their balance sheet since 2008 in quantitative easing. Yeah, that's absolutely true. And what's also absolutely true is if you look back at other business cycles, if the Fed had quadrupled their balance sheet, inflation would have done one of these. But if wages aren't growing and if commodities are going down and there's plenty of capacity, inflation can't go up. And the bankers are looking for plenty of reasons not to lend. So the result is the velocity of money or the multiplication. Probably the easiest way to explain this is you're a home builder, I'm a banker, I lend you $2 million to build houses. You go out and hire half a dozen guys, they buy trucks to get to work. Your new homeowners are going to buy carpet, appliances, tile, and what have you. And we're going to multiply the effect of the money that we lent you. So that's the multiplier effect that is somewhat broken now. But the main point is that inflation is barely measurable. Now there's a reason why I keep on this point. It's all about interest rates and earnings, right? Interest rates can't go up in any meaningful way if there isn't a lot of inflation in the system. So not long ago, the United States was considered the tortoise of the world economy compared to emerging powers like China and Brazil. Lately, it looks like slow and steady seems to be winning the race. So the U.S. economy is still strengthening. My opinion and that of others, the U.S. economy is unlikely to be significantly harmed by the recent turmoil in China. And consider that the United States now is growing twice as fast as Europe and 3 times as fast as Japan. Pretty interesting. So I want to shift just for a second and talk about the stock market. It's not just about China, folks. China got the headlines, but there are a lot of other things going on. So needless to say, it was the first 10% correction that we've had in almost 4 years. And a lot of the selling was driven by program trading. People that put together technical algorithms that try to trade the market. We saw pricing issues with ETFs that morning when the market plunged 1,000 points. Now, China was the reason to head for the exit, but really what hammered the markets were the program traders and the technical algorithms. It's become popular at some of the wirehouses to sell these market neutral funds. It's a bunch of nonsense, just a reason to charge a lot of fees. And they hadn't been tested up until last month. And what the markets clearly showed was there's no such thing as being neutral in this stock market. And they had a lot of pricing problems, and a lot of the pros say that it was the technical algorithms and the program trading that really drove the markets down, which was part of the reason for the rebound. So it's all about earnings and interest rates. Market's currently selling for 15 times next year's earnings. Guess what? That's right about average. I love when things happen when they're supposed to happen and how they're supposed to happen. Okay? Very methodical in my approach to the markets. So I love the fact that growth stocks started doing better than value stocks last winter. Okay, here's how this one works. If you're not used to flying on airplanes a lot, it can be somewhat unnerving when the pilot throttles back when they've achieved cruising altitude. Okay? The same thing for the economy. When we come out of a recession, we tend to grow a little bit faster than normal. We're in the recovery period. And at the point at which we morph into the expansion phase of the business cycle, right, the rate of growth starts to level off. And it's at that point that investors start to favor growth stocks. Right? You don't need to pay extra for growth stocks in the beginning. The rising tide lifts all boats. You might as well stay conservative on the value end of the market. So at the point that the economy has morphed from the recovery stage to the expansion phase, right, investors start migrating over to growth stocks, and that happened last winter. So number one, know that it happened. Number two, know that typifies the midpoint of the cycle, not the end of the ball game. A lot of folks all year have been asking me, hey, Bob, I heard that the average business cycle lasts 6 years. This one's 6 years old. Hey, come on, just between me and you, is it the top of the ninth, and should we be heading for the parking lot, or are we just in the middle of the ball game? And along with a number of other indicators, I like this one. Growth stocks don't come into play at the tail end of the cycle. That's not the time when investors increase their appetite for risk. It's the time we start hunkering down, looking for the exits, batten down the hatches. So the fact that growth is doing better than value now, to me, is an indication that we're in the middle part of this cycle. You look at earnings for the second quarter of this year, they weren't so good. Earnings were up for the S&P just 1%. Here's the point: if you strip out oil stocks, okay, about 1 out of 10 stocks in the United States is related to oil, and their earnings disappeared. So if you strip out oil stocks from the S&P, earnings were up 7.7% in the last quarter. So that's pretty good, folks. Rising corporate profits. For my stocks to go up, I need profits to go up, and I'm going to spend some time talking about why we are fairly convinced that profits are going to continue to climb. A client of mine, my buddy Fred, asked me the best question of the year a little bit ago. He didn't want me to embarrass himself. He's here now. So Fred, you get the prize, buddy. This is the question. And here it is. He said, Bob, if revenue growth is 5% in the United States, top line growth, revenue growth is 5%, how can earnings go up 7 to 8%? Companies have already gone through cost cutting relentlessly for years. And the reason is share buybacks. So as Isabelle will talk about different things companies can do with money, share buybacks now we're heading towards a record, right? So the pros think that share buybacks, so what we're talking about is companies buying outstanding shares. They reduce the number of shares outstanding, which has the effect of increasing per share earnings, right? And it was a big number this year, almost 2.5% that it's adding to earnings growth. My last point is profit margins. So this isn't unusual halfway through the cycle. It's pretty rare that margins are staying at record levels, near record levels. Halfway through the cycle, as I tried to explain earlier, your margins get squeezed because of higher wages, they get squeezed because of higher commodities prices, and they get squeezed because you're running out of capacity. Margins are near record levels now, and what that means in simple terms is the next sale that you make drops right into the cash register, okay? So margins are really high right now, and as I said, it's not unusual halfway through a cycle. It's just almost rare that you ever see that. So margins, of course, are what's driving profits. So we always talk about earnings yields versus bond yields. Here's the point I want you to remember. 6.7 is a bigger number than 2.2. Got it? So an earnings yield is, of course, just the reciprocal of a price-earnings ratio. But the simple point is you can take $1 out of your pocket now and get 2.2 cents of interest off a 10-year treasury. Or you can take $1 out of your other pocket and get 6.7 cents of earnings. Okay, now guess what? You know what the normal spread is between the earnings yield and the 10-year? 1.5%. It's triple now, right? You can get 3 times the yield out of a stock than what you can on the 10-year. It's one of my favorite technical indicators. As I mentioned earlier, we're now trading at 15 times next year's earnings. The pros think that the S&P is going to earn about $131 next year, which puts us at the current level of the S&P at 15 times next year's earnings, averages right at 15. So I'm really thrilled to be able to tell you that according to 2 of the biggest forecast services in the country, they think earnings are expected to go up almost 11% a year in each of the next 2 years. Now, one of the crazy making things about my job is, among other things, that there's a very close parallel between increase in earnings and increase in stock prices over the years. So over the last 30 years, profits in the United States have gone up tenfold. So have stock prices, tenfold increase. Now the crazy making part is I can tell you that earnings are supposed to go up 11% next year, but there's a very loose connection year to year. Right? So it doesn't segue into stocks are going up 11% next year, but ultimately it gets cut off. Right? So ultimately stock price increases reflect almost to the penny increases in corporate profits. So as you can see on this chart, obviously in the middle of the page, that's a number of years ago, 15 years when the markets were extremely oversold, overbought rather, and you can see the PEs were in the mid-20s. So we're right at the long-term average here, which gives me room for enthusiasm. So this chart, you can see on the left-hand side, earnings for 2014 for the S&P were at $118, right? So basically earnings didn't go anywhere from last year to this year, and that's all because of oil. Right, next year, they think earnings are going to go up 11.2% from the year-end level that we expect to hit this year, and a similar increase for the year following. We come anywhere close to that, and stocks will do pretty well. So this is the earnings yield versus the 10-year Treasury. Keep your eye on the far right-hand side of that chart, and the spreads continue to widen. That, needless to say, the yield on the 10-year is going to go up a little bit as the Fed eventually raises interest rates, but the spread is very dramatic now. And when you go back over history and look at times when the spread between the earnings yield and the bond yield was very wide, stocks tended to do really well. So on this chart, we're looking at valuation measures. I'm not going to read them all. The short version of the story is whether you're looking at forward PEs, price to book, price to cash flow, the PEG rate, or dividend yields, they're either at or below the 25-year averages for the stock market. Take that one home and study it. So the reason why profits are so high right now is that nobody's giving away the candy store on wage increases or benefits. Corporate profits as a percentage of our economy is almost at record levels. Take a look at this chart. Thanks to Kyle, this one goes back to 1950. And as you can see, for the longest time, corporate profits as a percentage of the economy, average, give or take, about 6.4% plus the inflation rate, which explains why stocks on average have gone up about 10% a year. So not anymore. Percentage of GDP for profits is quite a bit higher than the long-term average. Okay, I don't want to step on Isabelle's remarks, but share buybacks are huge now. That's on the right-hand side, and so are dividend increases. Interesting to see that dividend yields now continue to climb, and share buybacks, of course, increase per share earnings. So we look at this every 90 days. This chart looks at long-term 20-year average PEs for the 9 styles of stocks according to Morningstar. And then they look at the current PEs as a percentage of the long-term average, right? So what I want you to pay attention to is the upper right-hand corner. Large cap growth is selling for 85% of its long-term average PE. So the English translation on that one is you're getting a deal. Look at the far left-hand side, large cap value, getting a little pricey in that area, 110% of the long-term average. Now, if I go to the next chart, look what did the best. This is on a relative basis. It's been a tough year. But not only is large cap growth selling for 85% of its 20-year average PE, but it's held up the best this year with a 1%. As a general rule of thumb, I try to get a bargain on what I buy. It may stay a bargain a while, might become a better bargain, but generally speaking, I'm going to look pretty good over time if I got a deal on what I acquired. So this next chart, most of you know this punchline. Over sweeps of history, value does better than growth. The tortoise wins the race. Short periods of time, growth can do a little bit better. We're overweighting growth a little bit right now. We like growth, but it's important to remember that you need both. If you look at the long-term average, so on this slide, green is value. You look at the 30-year, value stocks have done better than growth stocks, and they're more conservative than growth stocks. Same thing over the last 20 years, value has done better than growth, and then for periods of less than 20 years, growth stocks have had the advantage. You got to own both in your account, and don't be afraid to overweight growth stocks right now. So this next chart talks about where the markets are at. I think it's way too early to do much bottom fishing in the emerging markets. Could get a little worse before it gets better, but at some point in time, 2-3 years from now, give or take, it's going to be a wonderful opportunity because long-term, it's where the growth is. So this chart starts in the beginning of 2013, and as you can see, the developed world's had a pretty good time, up 36% compared to the emerging world, losing 2%. This chart is just through the end of the second quarter, so the end of June, and it got a whole lot uglier for the emerging world since then. So when you're losing sleep at night over the markets, tape this to your refrigerator, okay? And look at the line. So it's obviously a log scale on an annual basis, and I'm going back a long time, way before any of you were born, but it starts in 1900, and it's pretty interesting to take a step back every now and then and look at the stock market historically. So as you can see from left to right, in the early part of this country, the market didn't go anywhere. The roaring 20s went way up, then it fell apart. But stocks historically stair step, right? So it goes up. After the end of World War II, we level off, then it goes straight up, then we level off. So the way I look at this, we're entitled to upward direction, which we clearly have since the end of the financial crisis. But it's good to take a long-term perspective. So before I pass the mic over, I got to talk about bonds and fixed income. The focus is clearly on the Fed. Know that resetting monetary policy at inflection points almost always involves volatility. So what that means in English is that if the Fed has been keeping rates low and they haven't raised for a long time, that's an inflection point. Or if they have been keeping rates high for a long time, they start lowering, that's an inflection point. Inflection points almost always create volatility. Know that spreads are widening quite a bit between investment grade and lower quality. We don't do a lot of high yield work at the firm. There's a real good reason for not doing high yield right now. A third of all high yield bonds went to the fracking industry. And boy, there's a tough business model. Their break even is $55 a barrel, and oil is at what, 41, 42? That's a tough way to make money. So a lot of them are struggling to pay back. Spreads have widened dramatically. Now that's just a heads up to stick to quality and fairly short durations on your bonds. Good client of mine, a retired doctor, lives in southern New Mexico, and I had a phone conference with him a couple weeks ago, and I was trying to explain this one on the phone. It's tough. So I'm going to use my hands here. If you look at this chart, it's an X and a Y axis of interest rates over time. The longer you lend your money, the higher the interest rate normally, okay? So here's short-term rates and here's intermediate rates. Typically when the Fed raises because they're worried about inflation, this happens. So interest rates down the curve go up. Most of the pros think this time around, this isn't going to move because there's not inflation. So when the Fed inevitably raises rates, it's just going to flatten out the curve. And it has a very different impact than what typically happens when the Fed is raising rates because of inflation. Remember that 8 out of the last 10 recessions were caused by the Fed raising interest rates to reduce inflation, and they put us in recession. 8 out of the last 10. So the 35 of us downtown, we get kind of nervous and twitchy halfway through the cycle, wondering when the Fed is going to stick it to us and end the party, right? And so we obsess about inflation. We obsess about interest rates, because 8 out of the last 10 recessions were caused because they raised rates. So why I'm telling you this is, absent any inflation, the Fed resetting monetary policy back to neutral should be viewed as a good thing. Every one of you should view the Fed increase as a good sign that they think the economy is strong enough to stand on its own 2 feet and survive a rate increase. We all think, hey, get it done with. Just one and done. We hope they're going to raise. It probably won't happen tomorrow, but probably by December they'll raise. And I just can't wait for it to happen, because it's a signal clearly that the Fed thinks that we're doing okay and we can survive higher rates. So we think that the yield curve is just going to flatten out a little bit, intermediate and long bonds. Art Rothschild asked the question to be asked. We were interviewing a guy, big shot bond manager, and Art asked, what do you think the 10-year yield is going to do when the Fed raises? And it was a great question, because it really speaks to the issue of inflation. And the portfolio manager's answer was that he didn't think the yield was going to do much of anything. And that drives mortgage money in the United States, the 10-year. So if it does move a lot, the housing recovery will stay in play. So this chart just talks about high yield. Please stay away from high yield. It's not worth the money. It's amazing how people have terrible memories when they invest. So high yield, you're going to get just a couple % more on your money. You got to remember that that category lost a quarter to a third of its money during the financial crisis. Hell, that's your safe money we're talking about here, right? So that's not what I do with safe money. I'd like to go into things that's bulletproof, where no ifs, ands, doubts, or buts, I can't get hurt. So stay away from chasing yield. It's starting to end badly in high yield, so stick to quality. This one I just want you to take home and read. Try to remember the formula. When interest rates go up, bonds go down. We've exaggerated this just to prove the point. You multiply the change in interest rate times the duration of your bond, and that explains price movement. So the part I want you to remember is almost all of you have durations on your bond portfolios in the 4 to 5 year range, okay? Stay there. You don't want to lengthen durations at a time when interest rates are going up. So here are some of the conclusions on the stock market. Most investors are going to need more stocks, fewer bonds, and more cash. So in the 40 years that I've been managing money, I've spent most of that time with roughly half stocks, half bonds. And the dynamics are changing now. When we study efficient frontiers at the firm, that's the point at which the next incremental increase in risk isn't worth the reward, right? So it's all back tested based on what the markets have done. But interest rates have been going down for 35 of the 40 years that I've been managing money. So it changes the way we look at the efficient frontier studies. So for those of you that can handle a little bit more risk, consider more stocks in your account. Here's another one I want you to remember. 3 is a bigger number than 1, right? So on short-term bonds paying 1, maybe 1.25, I can get a dividend from something fairly safe in the stock market. Now I get it. I'm comparing apples to orangutans here. But for income investors, 3 is a bigger number. And that 3 is capable of growing, your principal is capable of growing, versus the bond that doesn't stand the chance of growing. So you've got limited upside, a whole lot of downside. That's a lopsided trade. As a firm now, we're at about 60% in stock, which is getting higher for us. You want to make sure that you look at your income needs off the account, make sure you have at least 7, 8 years of that income sitting in fixed income, and of course everybody has a little bit different type of portfolio. We're all about risk reduction. A whole lot of Kyle's job is to figure out how can I best reduce risk without sacrificing return. Said another way, how can I increase return without taking on a lot of risk? Every now and then we'll hit the holy grail of figuring out how to decrease risk and increase return at the same time. That's harder than it sounds. But it's all about risk control. Economic growth is good enough, in my opinion, for companies to boost earnings, which speaks well for stock prices longer term. Okay, the last two charts I want to go over before I pass the mic on. This one's a really interesting chart because it speaks to the issue of risk and reward, right? So you want to take this one home and study it. But if you look at this chart, it starts at the peak of the market in October of '07, okay? So a portfolio that had 40% in stocks, 60% in bonds, took 25 months to recover. Portfolio that's at 60% in stock, 40% in bonds, took 3 years to recover. It's most of you. 100% in stocks took 4.5 years. Now this is just the S&P. If you include the NASDAQ, it took 5.5 years for 100% stock investors to get the money back. But look at the far right-hand side of this chart. How cool is that? Right? 60-40 mix, you didn't leave any money on the table. And you got your money back a whole lot quicker than the people that had all stocks. So I can't disappoint any of you. Wouldn't be a seminar without rolling out this one. So the simple concept is, way back when they figured out that if you get much past 50% in stock, your risk line keeps going up and your return line flattens out. So you don't get paid more for taking more risks, so don't. So if you can see this chart right in the middle of the page, 60% in stocks, 40% in bonds, return 9.8% over that 30-year period of time. If you dialed it all the way up to 100% in stock, you made less than 1% more on your money for 50% more risk. Got it? 1% more on your money for 50% more risk. Now, just as an aside, one of the reasons why Kyle is the director of research is that he knew the Greek letter for standard deviation. And if you look at that chart right in the middle there, it's probably hard to read on the photocopies, but that, of course, for some of you may know this. Kyle certainly did. I was really impressed that that's the Greek symbol for standard deviation. And the short version of the story is you don't get paid more for taking more risk, so don't do it. Most of you would be well served to do the 60-40 blend. Isabelle came to us as a college intern. She had returned from Rome where she did some of the studies, and she joined our staff full-time a number of years ago. And Isabelle's here to talk about corporate cash, what companies do with it, and the encouraging signs in what's happening now. Isabelle?
Thank you, Bob. For years and years, Bob has taught us that it's all about interest rates and earnings, and he's talked to us about both of those things already today. But let's take that earnings portion, look one step further, and understand how companies use those earnings and what effects those have on us as long-term investors. So I'll start with a really quick recap on where we've come with earnings. Since the financial crisis, the companies that were successful were able to get creative and find ways to make money, even going through those hard financial times. Interestingly enough, we also saw that companies were sitting on more and more cash, sitting on the sidelines. Just like many of us, companies became reluctant to spend because they were nervous and they wanted to get their balance sheets back in order until they felt comfortable with what they had in case this should happen again. At the end of 2014, companies are sitting on $1.73 trillion in cash. But things are starting to look better now. And companies are showing that they've become a little less reluctant to spend, and they're actually looking for ways to put some of that money to work for them. So with all this cash on hand and companies are eager to spend, what are some of the things they can do with it? Well, the first thing they can do is invest in other businesses. The way they do that is either through mergers or acquisitions. This year, we're on pace to surpass the last record, which was set in 2007 for merger and acquisition activity. Companies are finding a lot of value in either merging their operations or acquiring another business altogether. So that sounds nice, but what does that mean for you and I as investors? Well, the fact that it's a trend in and of itself is good news. You have to remember, businesses only want to do these deals if they think it's going to be good for them. So the fact that they're doing more and more of this means U.S. companies see value in other U.S. companies. I think that's good news. The next thing that companies could do with their cash is give back to their shareholders, and Bob touched on this a little bit already. They can do this through either share buybacks or through increasing their dividends. Like he said before, buybacks are also at record level activity. And when companies choose to use their cash for buybacks, what they're really doing is doing the quick and easy thing to do with some of their cash. They're taking some shares out of the open market and giving a short-term boost to their earnings per share. It's not a bad thing when companies are doing more share buybacks, but it also doesn't do much of anything to give you or I any confidence in what the business is going to be doing for long-term growth. Dividends, on the other hand, a lot of us like to see those increase. It's helpful if you take income from your account, and even if you don't, it helps towards your total return. Companies have been doing a lot more of increasing dividends, and it's thought that that's going to continue to go for the years coming. Now, the last thing that companies can do with their cash, and this is the one that gets us excited, is spending more on capital expenditures. That's things like research and development or plant and equipment. This is the way that companies can spend their money that translates into long-term growth, which translates into profits, which is good news for investors. You and I want to see companies putting their money towards things that's going to allow them to grow organically from within themselves. The way they do that is put more money into their research team, or put more towards the development of new or existing products. Or perhaps it's about time to put some money into their facilities or equipment that probably has been outdated for a number of years now. No matter how they choose to spend under this capital expenditures umbrella, this is the way that they're investing in their own company that's going to allow them to grow well into the future. So the trend for the past number of years has been for the majority of corporate cash to either be going towards mergers and acquisitions, or buybacks, or dividends as well. But some numbers are starting to suggest that that may be changing. I'll use buybacks for an example. The amount that companies spent on buybacks in the first quarter of this year was 9% less than what they spent in that same time period last year in 2014. So we're at a point where the trends appear to be changing, but companies are still sitting on record levels of cash in their book, and they're still looking for ways to grow their business with that cash. So what happens now? Well, the last thing that's left on the list is the spending and capital expenditures. And we're already seeing some companies doing this, whether it's investing in new talent, or again, putting more money towards their research and development, or their plant and equipment. But what gets me really optimistic is the companies that aren't quite there yet, or maybe they're just starting to think about it. Many of them had been spending in these other ways, or maybe they've just still been reluctant to spend and are still looking for a good opportunity to start using some of their cash. The fact that this looks like the new trend is going to be this new umbrella of capital expenditure spending is reason for you and I as a long-term investor to get excited about where U.S. companies are. And with that, I'll introduce to you Kyle Tetting, again, the Director of Research here at Landaas Company, who's going to talk to us a little more.
Thank you very much, Isabelle, for that wonderful introduction. Isabelle and I joked a little bit in preparation for this morning's event that I was going to come up here and tell some knock-knock jokes. Probably not the best setting for that. Call and response doesn't always work out in large groups like this. But instead of telling a knock-knock joke, perhaps I'll tell a story about a knock-knock joke. So in our house, we have a speaker that sits in our kitchen, so we can listen to music while we're cooking and while we're eating dinner. But the speaker will respond to you. So you ask it to play music, it will play music. You ask it to put something on the shopping list, it'll put something on the shopping list for you. What my 5-year-old daughter and 2-year-old son found out is that if you ask it to tell a knock-knock joke, it will tell you a knock-knock joke. In response to those knock-knock jokes, then, for the next 20 or 30 minutes, you have a 5 and a 2-year-old repeating those knock-knock jokes. I will tell you that the 2-year-old has some trouble remembering the words. However, his timing is impeccable. You don't necessarily know what he's saying, but you know that it sounds funny. The 5-year-old, on the other hand, she memorizes every line. but I will say that she doesn't share her brother's good sense of timing. So we started this morning with a nice video on balance, and I would say that the balanced investor very much understands that difference in how we go about things, right? That's stocks and bonds have different roles, they do different things well. But I think sometimes we oversimplify that process. It's not just about how stocks and bonds do, it's not just about how all these different asset classes fit together. It's about understanding that even within those asset classes, there are different purposes, there are different reasons for why what's in your portfolio is in your portfolio. And so I don't want to oversimplify that this morning. I want to spend just a couple of minutes talking about why we look a little bit deeper, why portfolio managers, the men and women who oversee the mutual funds that we invest in and the various investment vehicles that we invest in, why it's so important to understand what they do and to start to understand how to measure their success at what they do. So really there's a couple of different ways when we talk to portfolio managers that these conversations go. One is we talk to managers who are very focused on picking individual securities. They will talk for hours if you let them, and these conversations can be a bit dry, but they will talk for hours if you let them about their process of picking the next great company. And they build their portfolios from the bottom up, really looking at this is the next company I want to buy that's going to add value for my shareholders. The other way that these conversations tend to go, and we talk to these managers on a pretty regular basis to make sure that we understand what's happening, in your investments. The other way that these conversations tend to go is there are a number of managers out there very focused on these macro themes, building a portfolio from the top down, picking some great idea, for example, like an aging population that's going to be very beneficial to healthcare, and then trying to fill that healthcare bucket with ideas. Not that they're not focused on the stocks they're buying, they certainly are, but more important to their portfolio is this big idea. So once we know what those processes are for your investments, once we understand what a manager is trying to do, it's as important to understand how successful they are at doing it. And what you can see on the screen here is a very rudimentary way to begin to understand the success of a manager at that particular thing they're trying to accomplish. We try to attribute what their performance comes from. If it's a manager who's focused on stock selection, are they adding stocks that are outperforming their benchmark? And more importantly, as is often the case, are they excluding or are they underweighting the stocks that tend to underperform the benchmark? And in that way, we can get an idea of what kind of performance is being added by their stock selection. The other one, the sector allocation or the top-down type investors, we can look at a sector level. Are they overweighting sectors that have outperformed the benchmark? Are they underweighting sectors that have underperformed the benchmark? It sounds really simple until you get into the math of figuring out, okay, now how does that overweight or that underweight equate to overperformance or underperformance? Easy to look at a manager's track record and go, they've outperformed their benchmark from point A to point B. Or, 4 of the last 5 years, this manager has outperformed. More difficult to say is what the manager is telling us their strategy is what's actually adding that value. Because it's a lot easier to say, yeah, I've outperformed for the last 5 years. It's a lot more difficult to say, and I did it because of the things that I said were going to work. And that's ultimately what can drive long-term success, is not just a manager who outperforms, but a manager who outperforms on the things that they talk about outperforming on, the things that they're focused on. And ultimately, it's not just about picking a manager who does something well, it's about picking a lot of different managers who do a lot of different things well. It's about having the 2-year-old who maybe doesn't know the lines, but he's going to get the timing right. And it's about having the 5-year-old who understands the lines, but maybe has to rely on her brother a little bit to make it sound funny. You've got the managers who are focused on stock selection. Those managers are going to excel in certain environments where that is rewarded. And at the same time, there are certain broad themes that Bob has talked about through the years that we've tried to focus on, that when we align ourselves with those managers, we can take advantage of some of those broad themes. And that really can drive, the combination of those two things can really drive long-term success.